Hey everyone, how are you? I'm Jorge Sanchez, manager, owner, co-owner of Physician on Fire. Happy New Year for those of you who hadn't had a chance to wish you today. Welcome everyone to today's crucial webinar on 5 tax mistakes to avoid. We all know how hard we work to make the money and prepare for retirement. But what if I told you that some simple tax mistakes could easily be draining your income? Today, we have a very special guest who knows this struggle. It's Dr. Jordan Fry. He's a successful plastic surgeon, and he's the founder of the Prudent Plastic Surgeon financial wellness brand. His story is one of transformation. Today, he's going to give us insights on how to mitigate tax loss. We also have Brett Lamont. He is the Senior Wealth and Tax Advisor for Earned. He's a CPA also, and he's going to guide us on what we can do to avoid these common tax mistakes. Earned is a trusted partner of Physician on Fire. We've held many webinars with them. We've helped them develop their mobile app, and they're going to be one of our sponsors for our first ever Prosperity Conference in Las Vegas, March 6th through March 8th. So, gentlemen, good evening.
Thanks, Jorge.
Yeah, thanks, Jorge. Excited to be here. So I'll kind of kick things off. Here are some disclosures, which obviously we can share more if you're interested. So just really quickly, Jorge kind of introduced us both. I am still a full-time practicing plastic surgeon in Buffalo, New York. I specialize in microsurgery and breast reconstruction. And then I started about 5 years ago a financial blog called The Prudent Plastic Surgeon, just kind of sharing my journey from where I started financially, which wasn't good, to where I'm going now. And then Brett is the Senior Wealth and Tax Advisor at Earned, as Jorge mentioned. So we're going to kind of start out just going by the numbers and talking about doctors and taxes and why it's important to be mindful of taxes and to start thinking about strategies and being proactive to them rather than reactive. And then Brett and I are going to go over kind of the most common tax mistakes that doctors make, that we see them making kind of over and over again, and how to avoid them. And then Brett specifically is going to talk about some untapped tax and wealth strategies for doctors that he really helps his clients with, and stuff that I've been using as well. And then we'll close with a Q&A, really to answer any questions you guys have specifically related to this or more in general. So like I said, let's start kind of by the numbers. So probably not shocking, but taxes are a doctor's biggest expense. We all think about and talk a lot about student loans and things like that and paying that back. And that's certainly a big expense, but the biggest recurring one that we have is certainly taxes. The average physician in 2022, who this was kind of like last when this data was widely available, who are married filing jointly, paid $91,000 in taxes. So that's like more than the average income for the average American that we're paying in just federal taxes. State taxes, another $14,000. So again, we're above $100,000 that the average physician is paying per year in taxes. We often don't necessarily think of it that way until, unless we're studying our pay stubs every week or, at the end of the year looking over our W-2, but it's kind of like the silent killer because it's just always coming out of every paycheck we have. The median marginal tax rate of physicians is 35%. That's the second highest tax bracket, the highest being 39.6, around 40%. So that means that it's not every dollar we make is being taxed at that amount, but the majority of dollars that we make are being taxed at that amount. So obviously it makes sense to think about how to reduce these costs. If there's any other cost that we had that was $100,000 a year, we would be looking at reducing it. And I think a way, I kind of just used to look at taxes as this is just the way it is. It's what you pay. I always tell the story that, when I was a resident in New York City and, my wife and I, she was getting her PhD, we were living on just my resident salary with 2 kids. We qualified for federal assistance and we used it. So we've used the benefits and the good that tax can do. And so I'm very conscious of and happy to pay the taxes that I need to. But like a very famous federal judge said, you're required to pay what you owe, but you don't have to leave a tip. So I'm very cognizant every year about not leaving a tip. So everything that I can do legally to reduce my taxes, I'm going to do that. And basically the tax code, the way I think of it is the government laying out incentives for you to do the way that they want you to live and contribute to society. They incentivize via tax deductions and things like that. So again, a lot of the strategies that we'll talk about here. So that's how I look at it: is how can I align, my tax strategies with the incentives that the government is putting out there. So I'll briefly kind of go into my background and where taxes come in on that. So when I was finishing my training, that's when I recognized more so that I was experiencing burnout. And a huge component of that was a lack of financial well-being. I didn't know anything about finances. I actively ignored it because that was the taboo. We shouldn't think about money as doctors. That's kind of what I saw my mentors doing. So I was just financially in a very bad spot. So I started learning about personal finance. Physician on Fire was a huge resource of mine. And I first calculated my net worth, and it was this number. It was actually even a little more on the negative side. And it wasn't great. I then subsequently learned kind of what net worth meant. I started realizing that income is not equal to wealth, and it's about what you do with your money rather than just the money that you have. And I started doing the things to improve that. Just building basic habits like saving, a good percentage, at least 20% of my gross income, learning the right ways to invest that money. And then after I started doing that, the disconnect that I had between this image of a rich plastic surgeon and my reality that was really bugging me, it started to alleviate a lot. And I stopped living by the expectations I felt from, the field of medicine and the public at large, and just by what was important to me. And so at that point, I was really kind of on a relatively, straight path financially, in terms of, I was saving money. I was spending what I was spending intentionally. I was investing it in index funds and, started investing in real estate and things like that. And so after building those basic habits, the next biggest thing that kind of came up that I had to learn how to manage with my finances was taxes. And so, the first year of being an attending, we had like a huge tax bill. And again, that was really eye-opening because coming from a resident, usually you get a refund, and all of a sudden it was completely flipped on its head for me. And so, again, I had to say, what can we do about this? And started learning about taxes and tax strategies and, talking to folks like Brett and things like that, in enacting a plan to address this. And I think that's the biggest mistake, is essentially just avoiding it or ignoring it, or kind of, closing your eyes and hoping every April that things are okay. And so that's, again, why we want to talk really specifically about tax mistakes, how to avoid them, specific strategies that you can use, because these will be some of the highest return on investment things that you do financially. So with that, I'm going to have Brett kind of talk to us a little bit more about these numbers here.
Thanks so much, Jordan. I love that story. I've been at our firm for a little over 10 years, and I've had so many clients come to our firm, right, for tax prep and assistance with their wealth creation and investing strategies. And they just get sidelined by that first year when they start making, good money, especially people with 1099s or multiple jobs, when they just get slammed with that unexpected tax bill, right as they're starting to kick off their earnings. And our firm is the first comprehensive wealth manager for physicians and dentists. We specialize with physicians, so we are having discussions day in and day out. They're having these problems with student debt that's piled up, trying to buy a home, trying to buy a practice, trying to figure out their taxes. And that's all we work on all day long. And, the biggest, factor, everyone wants to save in taxes. And just to set the stage here for this discussion, as wealth managers and investment advisors, we're always thinking, okay, not just what we can save right now, but what is that going to compound into, right? If you can save money in taxes and then use that money to fund your investment strategies, if you had a compounded rate of return of 8% annualized every year, a $25,000 tax savings properly invested can turn into $391,000 in 10 years, 1.2 million in 20 years, and over $3 million after 30 years. So we always want to look at what is the compound effect on that money, and really, make sure that our clients are taking advantage of that savings, and always trying to get more money working for them. We'll jump to the next slide here, and we're going to jump into some tax mistakes. Is it reasonable? Can like an average person really save $25,000 in taxes? My answer is it's a resounding yes. I mean, we're going to get into some stories with clients and some examples, but the initial mistake that people make is just not planning. And Dr. Fry, do you want to speak to this a little bit about failing to plan and maybe some of your insights there?
Yeah, I think it's like that classic kind of idiom or whatever. Like, if you fail to plan, you plan to fail. And what most people end up doing, I know, even just talking to a partner of mine recently, they're just like, I don't understand. You referring to me, look forward to like tax season, and I just dread it completely. And I was like, yeah, it's because I planned for it the whole year and I'm proactive about it, versus he, up until that point, was just very reactive about it. And you kind of realize that, like, a person, a tax person that just files your taxes is very different from a tax advisor or tax strategist that is holistically throughout a year looking at strategies and enacting strategies, using it specifically to your situation, which may change on a yearly basis, how much you have, if you have passive losses, passive gains, etc. So when you're talking to someone, you really want to make sure that they're comfortable with the full range of tax strategy, and ask them, like, do you work with high income earners? Because some people might not. They might just be working with people who in general are meeting deductions and getting a little refund every year just based on that or something. So you want to know that they have that experience. That's super important.
I want to add to that, just in regard to the different CPAs out there. So there was a stat, I believe it was 46% of physicians opt to file their taxes on their own. So over half of people are using a professional. However, there's a lot of firms out there that let you come in, once a year with all your tax documents, and they prepare your return, and then they tell you how much you owe or how much refund you're getting. And then that's the last time you see them, unless you proactively call them up with a question. And, seek out somebody who's going to be planning with you, who's going to have a mid-year meeting, a year-end planning meeting, who's going to outline your tax payments that you need to pay over the year. And just make sure that whoever you're working with is a professional that's going to be as proactive as possible on their end as well.
Yeah, exactly. And it's kind of like, there's never too late to start. Even honestly, if you're like right now, hey, what do I do? It's never too late to start. Have someone review, see what they can do kind of retrospectively. But then, now is a really good time to start for 2025. If you're not happy with where 2024 was, to say, okay, what am I going to do? Because a lot of times these things are not, it's not like just a certain box you tick on the different forms or something. It's things you have to do throughout the year. You may even have to save up for certain types of investments to then get tax benefits and stuff like that. So you want to start thinking about it early in the year. So that's why this is very timely now. And Brett, can you tell us a little bit about this kind of low-hanging fruit mistake?
Yeah. Tax mistake number 2 is not maximizing employer-sponsored retirement plans. And I just had something to come to mind. I think I want to share before I get into this. Actually, I had a client who came to me in October. Just reiterate planning. She had done a build out on her dental practice, and we were kind of going back and forth. Do we accelerate the depreciation on that or do we not? And you know, the default write-off when you do a build out on a commercial building like that is to kind of write it off over a 15-year period of time, or you can accelerate it all, even if you got a loan on that. And we decided at the end of the day through that planning process, let's take the accelerated depreciation, and that was going to drop them into the 15% tax bracket. But then we were looking at the IRA accounts that they had, and so we didn't stop there with the depreciation. We opted to then write off or to do $150,000 worth of Roth conversions and get $150,000 worth of IRA money over to Roth, where it can grow tax-free the rest of her life, just at these really low tax brackets they'll likely never ever see again. So really powerful opportunities there that come up anytime you have something major going on. Make sure you talk that through. With the retirement plan options, I hear a lot of stuff that just really gets me fired up. You know, you'll hear people online on social media or, you know, friends, hey, the 401k is dead. We do not believe in that here, right? The employer-sponsored retirement plans are great options. You know, we had a great market in 2024 and 2023, great upside, and you can have great returns in your investment. A lot of people have a little bit of uncertainty there with the, you know, okay, am I in a lower tax rate now than I will be in retirement? And that conversation, you know, where a lot of people think, you know, tax rates will go up over time. If that's your belief, if you really think that tax rates are going to go up, you know, 401ks still have options to put money into Roth. You don't get a tax deduction up front, but it gets in the Roth and it can grow tax free. And so you can pay the tax on that now. So don't let all the confusion there, you know, persuade you to not like put your money into your employer sponsored retirement plans. I had a client reach out and he said, hey, should I just put money in up to the match? And it's like, well, really, you should be saving a solid 20% of your income. You know, you're in the high tax brackets, max out your contribution. You need to put more money away anyway, so that you can be on a path for retirement. And so, you know, the match is great, but often we're believers that you take full advantage of those 401k plans, the 403bs, if it's you know, not a private entity. The 457 plans can be supplemental, and you can also contribute to a 457 if you have a 403 or a 401k, and really have some great options to put money away and have an employer contribution as well.
Yeah, I feel like this is something I see people sort of like overthink almost. Like, don't make it more complicated than it is. Like, these are tax advantage accounts. You get to invest your money and enjoy some tax benefits. Is it like they all have different advantages? And that's kind of what we're going to get to in a second. Here you can see kind of what the contribution limits are, or were in 2024. Mm-hmm. But, you know, yes, would we all love like an account that is like triple tax free and everything like that? Of course. But these accounts do help grow your wealth. They reduce your taxes. They're very protected. I hear people refer to them as money jail because the money's in there until you're a certain age. You can't withdraw it. There are a lot of kind of opportunities in specific situations to withdraw them if you're like ever really needing the money. But quite honestly, for the most part, you're saving and investing this money for that time in your life anyway. So in that sense, it's almost like a behavioral hedge to stop you from maybe doing something that is not super financially wise.
Yeah, I think that money is sacred funds, right? You're not touching
Yeah.
it until you're over 59 and a half or retired anyway.
Right.
You don't have to start drawing money out of those until you're 73. If you're putting money in tax deferred, you do have to start drawing money out of those plans when you're 73, and that's when that would become taxable if you were taking deductions and doing pre-tax deferrals into those accounts, through your
Right.
working years. And one thing I want to shout out on that those contribution limits, right? There was one that wasn't on there. If you're turning, so you've got the catch up over there, which means that if you're over 50, you can put in an additional $7,500 into your 401k. So if you're turning 50 this year, make sure you reach out to your employer and have them increase what they're taking out of your paycheck by an extra 7,500. You can just simply take the 30,500 or 31,000 in 2025, and divide it over how many paychecks you have, and just call it into your payroll team. Let them start taking that out, so you hit the max at over the year. If you're turning 60, 61, 62, or 63, there's an additional catch up over that. So instead of a $7,500 catch up, there's a new catch up this year where you can put in $11,250 as your catch up instead of the 75. So if you're turning 50 or you're turning 60 to 63, make sure you get those extra contributions in. Go ahead and increase your limits so you can max those out. This is a great chart. It shows all of the different vehicles that you can use for your retirement plans. And so you guys are going to be in the higher tax brackets. You saw the average for physicians. The average tax bracket was 35%. So every dollar you put into these types of accounts, minus the Roth and the traditional, is going to save you taxes. If you live in a high state tax like California or New York, you're also going to be saving state tax for the money that you put into these types of plans. So the simple IRA, if you guys are in a setup to where you have options to get 1099 income, we'll talk about that more here in a little while. You can set up simple IRAs to offset. If you don't have 401k options, that's a starter plan. SEP IRAs, if you don't have any staff, are great options. You can fund a SEP IRA and a 401k. I get that question a lot with people who are going to start a side gig, or maybe have some independent contractor income or consulting income, all of those types of things. Lots of times they're already funding their 401k and maxing that out at their, with their employment, their W-2 wages. But then you can also set up a SEP IRA and fund, 25% of your 1099 income to that. One thing that I want to call out on the defined benefit plans, those cash balance plan, that's that big contribution. Yeah, the 250, you can put up to $250,000 into those per year. One of the mistakes that we see is we work with a lot of physician groups, and they'll have like a partnership of S corporations. These are like typically specialists, physicians that are create a group, and then they get either 1099 income from hospitals or different contracts, and that money goes into a partnership with staff, and then all of those owners will have an S corp where they'll, many times we see they try to set up a cash balance plan in their S corp. That is a blunder. If you're getting advice to do that, make sure you vet that out. Typically, those cash balance plans need to be set up under that main entity, the partnership, and you've got to allow those staff, any staff you have, into that plan. So if you want to put in 250,000 for yourself and you have some staff on payroll that are full-time, you probably need to contribute a percentage of their income as well. So I wanted to call that out as a mistake or a confusion that we often see with those big plans.
That's a great point. And I think with all of this, the way it kind of ties in is important. And another mistake that I see a lot is people will kind of concentrate their investments into one account type in terms of tax treatment. So again, there's kind of broad range, 3 main types of accounts, right? There's a taxable account, which again, without getting too technical, is taxed on the front end and the back end. Then you have your tax deferred accounts where it's not taxed up front, it's taxed on the back end. So it's like your 401k, 403b, 457, traditional IRA. And then you have your tax-free accounts that are taxed up front, but then never taxed again. Those are like your Roth accounts, Roth IRA or Roth 401k or something like that. You want to have a good mix of where your investments are in terms of tax treatment. You don't want to have necessarily everything in a Roth because then you're getting taxed very heavily up front. You don't want to necessarily have everything in a tax deferred because then later on you're going to get a big tax bill when you take it out. You kind of want to give yourself in the future the ability to take money out and withdraw to cover your expenses that has some tax flexibility. So again, depending on in your retirement or towards the end of your career or wherever you are, depending on what income bracket you fall in, depending on, I mean, things as simple as just what the political environment is in terms of where tax brackets are and stuff like that. So you want to give yourself flexibility. Again, talk with your tax advisor, like Brett gave that great example of the dentist, I think it was, who was building out, and then that created an opportunity to do a huge Roth conversion, so to convert tax deferred money into tax free money. So that's going to give her a great deal of kind of flexibility and ability to be nimble in the future. So you want to have a healthy balance of kind of these different types of accounts. And again, kind of like Brett alluded to this as well, if you're a physician, you should be, a good rule of thumb, saving 20% of your gross income. You're going to be able to fill a lot of these different tax advantaged buckets. You should really be able to fill most of them. So you're going to be able, whether it's with, 401k and then a 457 and then a Roth IRA through the back door and then a taxable account, you're going to kind of, hopefully by necessity, give yourself some of this flexibility, but you really kind of want to think about that. And this just breaks down again the 3 different types of accounts that are out there. You don't necessarily need to have it a third, but you want to have some proportion in each.
Yeah. On the third, I get asked that question a lot. Like, how much should I be putting into each bucket? Like that's a common question. And my take on it is as a tax guy, I love to do what we call bracket targeting, right? And so you saw the other, like all those options, right? With the cash balance plan and your profit sharing and your 401k, like that's all tax deferred. And I love tapping into that as much as we can until we can get down in maybe the 32% bracket range, or maybe it's even lower. The 24% tax bracket starts at $394 if you're married, or it doesn't start there, it ends there. So once you're making 400 plus, you're out of the 24% bracket. And then it jumps to a 32% bracket. That ends at 500,000. So if you're making over 500,000, let's say you're making 600,000, right? You may want to put $100,000 in to those tax deferred accounts, right? And drop down to the lower tax bracket. And then any other savings you're going to do in addition to that, yeah, maybe you can put it into your Roth or a taxable brokerage account or your other, fund to buy your next real estate acquisition or whatever it is. There's lots of options there. But but we often want to look and see if we can get you to the next bracket down with those tax deferred buckets. But it's a very common mistake that lots of people are just so focused on that they just put everything in, even if they do drop to a lower bracket. So we want to analyze that.
Absolutely.
Yeah.
Oh, go ahead. Sorry, I was going to say.
You want me to take this one? The business expenses. A lot of you are W-2 employees, and I just want to clarify, like the write-offs. There used to be a way to take like miscellaneous itemized deductions on your personal return if you were an employee, and that ship has sailed. That is not available anymore. And so really, if you're trying to get deductions, you either need to do that via expense reimbursements through your employer. So if you're negotiating contracts of employment and you're just a W-2 employee, maybe they can give you a reimbursement plan, or maybe they have an accountable plan where you can write off your cell phone and your dues and your CE and licenses, and maybe they give you an auto reimbursement or student loan reimbursement of some sort. So there's lots of things and ways to negotiate with an employer if you just don't have business income. If you have, if there's not an option for that kind of thing, really look and see if you have the ability to generate some 1099 income, whether it be consulting or a side gig or working a day a week somewhere else. There's oftentimes opportunities, right, for this group to get 1099 income or even start your own business. And we want to make sure you maximize that. You don't have to just have an increase in income. We want to increase the income and not have to have additional taxable income, right? And probably the most common question I get asked in terms of like, what can I write off? People are always like, can I write off my car? Should I buy my car through my corp? And that's a very common one. Yes, vehicle write-offs are a thing. You can expense your vehicle, but there are limitations that a lot of people don't know about. And if you're buying luxury vehicles, there's limitations that could limit your write-off to $30,000 or $25,000, depending on the kind of car. And you want to make sure that you're not making the assumption that you can just write off the whole thing, which is a common mistake. We talked about that supplementing income. If you are going to get a 1099, I think that the first question that's probably going to come to mind if you're going to get some 1099 income or start your own business is, should I incorporate? I get that a lot. And I just want to reiterate this point that a lot of people don't understand. You do not have to incorporate or have an LLC to get business write-offs. You do not have to do that. It's a very common misconception where people think they have to. I think a lot of attorneys are pushing like, hey, you should set up a corporation. There's liability protection for a corp, and there's other things to consider there on the legal side of things and liability protection. But from a tax standpoint, there's potentially no benefits to incorporate. It really depends on how much income you make. My general rule of thumb is, if you're making less than $200,000, you can just run it as a sole proprietor and not have to have the expenses of a corporation and the nuances and having to run payroll for yourself. If you do incorporate, you have to put yourself on payroll and pay yourself payroll, like wages, as an employee of your corporation. And so, make sure you look at that. If it's just a little bit of 1099 income, you can just simply report that on your personal tax return and still be able to write off expenses against that.
So, Brett, next, we're going to talk about some of the other, and this will be a little bit of a quick hitter, but some different untapped tax and wealth strategies for doctors that you find are really effective. And custom indexing, I know, is a big one that you and Earned in total kind of really champion. So maybe you could explain a little bit about how that works.
Yeah, we really think we have the best in class option for this. maybe I'm a little biased, but let me just explain what this means. Most people are investing via mutual funds or ETFs, right? You can go buy, the Vanguard funds, low cost index funds are very popular. You can go buy an S&P 500 fund, and now you have exposure to all the, 500 companies in the S&P 500. That's great for people that are starting out. That's great maybe for your 401k. But if you're doing supplemental investing above and beyond your 401k in a taxable account, in a brokerage account, you really want to consider custom indexing. We like to think of that box up there under the mutual funds as a locked briefcase. You can't really do much to that. It's like you get the fund and that's it. The custom index gives you the ability to say, hey, I want to track that same index. I want to track that S&P 500, or I want to track the total U.S. market. But you can exclude certain industries. Maybe you want to exclude the tobacco industry because you have some, beef with them, or maybe it's oil, or maybe you just want to track the index. You've got a lot of customization there that you can do if you want it on the investment side. But better than that, it allows you to do what we call tax loss harvesting. And I think most people have heard of tax loss harvesting. It's really hard to do if you're buying mutual funds, because the whole fund has to go down to tax loss harvest. Where if you're in a custom index and you own this bucket of individual stocks, your portfolio will do similar performance to that index, but now you can pick off those losers in a systematic fashion. So the way we handle that is we have periodic cycles where we're running trades and looking at all the positions in that portfolio and picking off all those losers in there. There's a thing called a wash sell rule, which means if you sell a stock at a loss, you can't get the tax benefit of that loss if you buy it back within 30 days. And so there's a lot of really cool software being utilized to track maybe correlated stocks, or to track that timing to where we can rebuy that stock after the 30-day wash sale. And now you can get a tax benefit and still have the opportunity for your portfolio to continue to grow, but accumulate these losses over time. There's a graph on this next slide that shows that, like the S&P 500 did great last year, right? And I think in 2023, it was also up 26%. But I think there were over 75 companies in that fund, even though it had great performance, that still had periods where those stocks went down by 15% or more over the year. So we can pick those up, and the way the losses work is, we're not trying to lose money, but we're buying back and hopefully riding that back up, and you get the performance over time that the index would do. If you do get losses in your portfolio, let's say you're able to loss harvest $10,000. You can use $3,000 of that loss on your tax return if you don't have any other gains. And any unused losses over that would get carried forward into the future year. So, a lot of you guys will own practices that you want to sell someday. I had a client who had equity in a surgery center that he sold last year. And, those kinds of activities are long-term capital gain events. And so, these losses that you roll into the future years or accumulate can be used against those long-term capital gain events. Selling a house, maybe you have highly appreciated stock that you bought a long time ago that you want to liquidate. This just gives you flexibility to plan better and take advantage of highly appreciated items and assets that you have without triggering tax. I want to speak a little bit more about the surgery center example that I brought up. So that client, he sold his surgery center for $1 million, and $300,000 of that was going to be ordinary income. That was like the assets of the surgery center, taxes, ordinary income. So your normal tax rates. $700,000 of the surgery center was taxed as long-term capital gain. And so what we did for that client is he sold like the first week of January, fortunately, and it allowed us to take the entire $1 million. He didn't need that money. He still had his day job. We took the $1 million and we put it in one of these long short portfolios. And we were able to generate a $250,000 loss while his portfolio went up about 24% in 2024. And so instead of having to pay tax on $700,000 long-term capital gain, right? We haven't filed his tax return yet, but I'm excited to see the results here. He's basically only having to pay tax on $450,000 of the long-term capital gain. So we saved him tax on $250,000 of long-term capital gain with these very powerful loss harvesting strategies called long-short portfolios. There's a lot of nuances. I'm not going to unpack all the details on that, but basically the gist is Fidelity will give you extensions on your portfolio. These are more advanced portfolios that require $500,000 or more to implement. And the reason they're so powerful is because you're using long and short positions in your portfolio. And the way it works is if you put $1 million into this strategy, right, Fidelity will give you $450,000 on margin up to that. And then you offset that risk with an extension they'll give on your portfolio of an additional $450,000 of long positions. And so, or short positions. So it allows you to basically have almost double the money working for you in the strategy to just accumulate more losses and really accelerate the damage that you can do on taxes. Jordan, I'll cover these other ones here on these next slides, and then we'll kind of do a recap here. The backdoor Roth, on the backdoor Roth strategy. Here we go. The backdoor Roth is something that I think everyone should be doing. Like Jordan said, almost everyone in this group should be able to fund their 401k and then ask the question, well, what should I do next, right? Ideally, there's enough money to work with in what you're setting aside for investing that you can do both. The backdoor Roth is important because if you're married, you can't fund directly to a Roth IRA if your income is over $246,000. That's going to exclude most people in this group. You can still get money into a Roth via the backdoor Roth. So the way you do it is you can fund up to $7,000 into a traditional IRA, and then it'll sit there for maybe a day. And then you just simply convert it over to your Roth IRA. And that's now going to grow tax-free. So one common misconception is that, spouses can take advantage of this as well, even if they don't work. So if you have a non-working spouse, they can also fund their IRA and use your earnings to do that. So you can really fund $17,000 or $14,000 if you're under 50 to this strategy. If you're over 50, you can get an additional $1,000 per spouse. So that can do a lot of damage because that money grows tax-free. And if you do that over time, really, it's really feasible to have over $1 million in your portfolio in tax-free money that you can now draw from through your retirement years. Let's go to the next slide here. If you're single, the limit to fund a Roth IRA, by the way, is $150,000 to $165,000. Like, you can't fund a Roth IRA directly if you make over $165,000. Smart asset allocation is a great strategy. A lot of people will make a mistake by just saying, hey, I'm like 45 years old. I think I should have an 80-20 portfolio, 80% of my investments in stocks and 20% in bonds. And then what they do is they just apply that same investment mix to all of their accounts. If you are going to be an 80-20 allocation, 80% equities and 20% stocks, we really want to look at like, how can we optimize the overall tax impact, right? We want high growing assets in your Roth accounts, right? Because those grow tax free. So if you are going to have, some allocation to fixed income, right? We want to get that fixed income in your tax deferred assets, right? Your 401k plans or your cash balance plan or IRA, your SEP IRA, because that money will grow and you'll have to pay tax on it in your retirement years. And so we think that, there's a much better way to do it than the standard, like, hey, I'm just going to split everything 80-20. And this kind of just shows a chart of your more tax efficient assets. Those should go in tax deferred accounts. Your less tax efficient assets, really need to be in the like your REITs and stuff like that. Those should be like in a taxable brokerage account and give you the tax advantages of the asset allocation that you can take advantage of across those buckets that we talked about: Roth, taxable, tax deferred. Optimized withdrawals. So that was referring to money going into your accounts and investing it like in an optimized way across your account types. This is talking about taking money out of your accounts in a tax efficient way, right? And so if you have tax-free accounts like your Roth, you really want to let those bake as long as you can. Roth accounts are great to leave to heirs because your heirs won't have to pay income tax on those. So if you're going to leave any assets behind, you really want to leave like your Roth accounts or assets that are going to get a step up in basis when you die. And so it's really important to optimize your withdrawals by determining, what your bracket's going to be in retirement and bracket target, right? How much money do you need to take out in your tax deferred accounts? How much money are you going to take? And really focusing on letting your taxable and your Roth accounts grow as long as they can, so that you can tap into those in your later years and have more growth in a tax advantaged way. This is a great slide. It's a lot on here. And so we're only talking about a handful of strategies here in detail, but this slide is kind of just showing the opportunities that are out there that we're not going to talk about, right? But some of them on here that we did: tax loss harvesting, the tax deferred accounts, your backdoor Roth. We talked about those, but there's so much more over that. If you guys are looking into real estate, there's a lot of misconceptions about real estate in terms of like being able to do huge write-offs. And if you're going through any planning options like that and trying to buy real estate and stuff and seeing how that fits in, talk to me, talk to a qualified CPA that knows the nuances of real estate and the deductions there. We're not going to get, that's like I said, a whole other webinar, an hour-long webinar with those. But when we get into the Q&A, if you guys have any questions about any of these specific strategies, you can throw those out, and we're happy to go through and detail some of these. If you are going to have an S Corp, the reasonable salary was on there. I wanted to point that out. The reasonable salary is what you would need to pay yourself as an S Corp. And I just want to call that one out, because if you're gonna set up an S Corp, a lot of people forget that they need to pay themselves payroll as an employee. And then it's like, well, how much do I need to pay myself as payroll versus income I can take? And, there has to be some analysis done on that. But the IRS put out a report and said there were 266,000 S corps that had over $100,000 of profit without any officer compensation. That's like an audit waiting to happen there, and they're looking into stuff like that's happening. So make sure that's not you. The impact of all this, right? If you can save 25,000 plus a year and invest it, you have the compounding effect working in your favor. And we're talking about tax management. This is also on the investment side. If you're using smart asset location strategies and you're optimizing your portfolios in a way that there's tax efficiencies going for you, the tax loss harvesting, it can really have a huge impact on your overall wealth over time. And I just love this chart and the power of compounding. Jordan, is there anything else you want to add to that, and any other insights on the power of that compound effect over time?
Yeah, I think that's really the key, is you have to, think about it in this way. And the money you're saving in taxes is akin to more money you have to invest. And again, that might compounding. I mean, you see it there, $3.3 million is a huge amount. I mean, I would say the sweet spot for a lot of doctors, and you think about how much you need in a nest egg to retire, is about $5 million. That translates to roughly $200,000 of spendable income via the 4% rule. And again, these are general rule of thumbs, but if you think you can get there really just by tax strategy, I mean, that's pretty incredible. And it becomes very obvious that you're going to reach your goals pretty quickly with the other stuff you're doing as well. So, hopefully we've been able to demonstrate that this is very important to think about, very important to handle proactively, and that's really the benefit of where Earned and folks like Brett come in. I'm a very big proponent of do-it-yourself investing. I think all doctors can do that. But, again, some people are going to elect to use a financial advisor. You should make sure you're getting a good price and getting good advice. Tax strategist, this is someone that you want to have on your team, that you want to make sure, again, you're paying a fair price, but a good tax strategist, it's going to cost some money, and it is worth it because of all this. So this is, again, someone you need on your team. Something that, as your situation gets more complicated, you shouldn't really be DIYing it. So that's sort of my thoughts about that. And then I know, Brett, you had an offer to extend to everyone here that's really very generous and a great opportunity.
Yeah, it's tax time, right? You're thinking about taxes now. Hopefully you're getting prepared to file. So, that's coming up. I would love to do a 30-minute consultation with anyone that has, these planning opportunities going on, whether it be 1099 income or even just talking about hey, where you want to be down the road, and what I've seen other clients do to get them there, and maybe there's some ideas that we can pull out for you. But please consider that. We're going to have a QR code, I believe, that you can scan. Yep, there it is. You scan this QR code, it'll go to my scheduling link. You can book a 30-minute consultation with me. I've got my calendar fairly open over the next several weeks. So take that opportunity before tax season gets wild for me over here. And whether it be real estate strategy, wealth creation strategy, just maybe you have big things going on, selling a business, and there's just so much planning opportunities baked into all these things that can really move the needle in your life.
Cool. For everyone, you're watching 5 Tax Mistakes to Avoid. I've got Jordan Frey. He is the founder of The Prudent Plastic Surgeon. I got Brett Lemon, CPA. He is the Senior Wealth and Tax Advisor over at Earned. And if you came late for whatever reason, don't fret. We will have an email sent to you with a link that you can see this webinar in entirety, and you can take notes. You wanted to take some shots at some questions while we have time? Let's see. We've got
I love that.
Dr. Shah. Is it better to, and this I think slide number 14, is it better to invest in employee retirement plan all upfront to maximize time in market versus biweekly through the year to get company match?
So a lump sum contribution in versus spread out over the year.
Mm-hmm.
Yeah, I mean, if you're worried about timing risk, right? There's no issue putting money in every paycheck as you go through the year. Dollar cost averaging in, that'll kind of smoothen things out. But the mistake I always see is, I don't know why, but a lot of people tend to wait till the end of the year to get contributions in. And it's just, I see so many people out there that ride these large cash balances in their business checking accounts, in their personal savings, and have all this excess cash on hand when they could just be putting it in systematically into the market. And if you do have a business and you're making the employer portion of your contributions, the due date to fund those isn't until the tax deadline date, right? Those are due March 15th. We always have people, trying to fund those up to those deadlines. And I really challenge everyone on this call to get ahead of those if you're in that situation, and really get that money funding through the year.
Dr. Teresa Lass would you max your 401k or invest in real estate?
Yeah, I mean, there's a hierarchy, right? You really, what's your core strategy, right? The 401k probably comes with the match. You're getting a tax write-off. It's systematic, it's diversified, right? And you don't have to have the nuances that come with real estate. We're big advocates of the 401k. And I always hate to see people get persuaded because of, someone who had a really good year in real estate because of great timing. It shouldn't demotivate you to fund your 401k. Jordan, do you have anything to say about that?
Do both.
Yeah. I love that. I love that so much.
I have, again, quickly, in my retirement or my financial plan, again, it's like buckets. The first bucket to fill in is maximizing my 403b. I do that, then I do a 457, a backdoor Roth, and then it starts spilling into real estate and a taxable account.
Got it. Dr. Crespin asks, should you pay estimated taxes first or put money in a 403, 401b? Which I think is, you already kind of answered that.
Do both.
Yeah, do both.
Right. If you're budgeting, right, it's a matter of, okay, I know what I need to put away. If I'm putting away 20% in savings and investing, and then you're putting away another, 25% or so as you go through the year in taxes, whatever your ratio is, make sure you're budgeting for that.
So Dr. Ann Light asks, what is a cash balance plan? Does that work for sole proprietor LLC?
Yeah, it works for all entities. You can be an LLC, a corporation, a partnership. And those plans work great if you don't have a lot of employees. They work great if you have employees and you're older than your employees. But those allow you to put so much money away. If you're in those high tax brackets, 37% tax bracket, 35% brackets, you really can take advantage of additional tax deferred savings. And those do work better typically if you're older. You can't put in as much if you're only 30, right? I have a 33-year-old doing a cash balance plan, and they can only put in $117,000 only. But so it's a lot of money to put away, but you have to hire an actuary, and they'll help you figure out how much you can fund to that plan.
Okay. Someone else, I already maxed out my 403b with my health system employer, but they also offer a 457 plan. What are your thoughts on these?
Yeah, I would want to know like how much money are you setting aside? I wanted to ask this earlier, like how much money is everyone setting aside and like in this group for investing, right? And the 457 401k, right? I want to look at like are we filling up all of our buckets? Fund that 403b, right? Where do you have money? Like, do you have any extra money to go into those other buckets if you're doing the 457? If so, right, do the 457 and then work on filling those other buckets. Jordan, do you agree with that?
Yeah, I agree. The one caveat with the 457s is obviously, and you kind of brought it up briefly, technically the money that you put in that account, it's not yours until you take it out. So if you're working, like I work for a public institution, it's very stable, etc. Like it's government funded, it's not going to go under. So I feel very safe contributing to the 457. If it's like a newer private health system or something like that, you may not feel as comfortable. But yeah, in general, I think if you have that tax advantaged account available to you, it makes sense to use that. Um, Again, you're just going to save.
What does Earned Wealth charge for their services?
Jorge, are you there? Say it again. Cut out a little
What
bit.
does Earned Wealth charge for services? What's your fee structure?
Yeah, so we handle everything from tax and accounting and payroll and pension and wealth management and financial planning. And so we do have a fee schedule that's based on assets under management. And so, it depends on how much you're putting in. Those fee schedules start like if you're just getting started and you want a full blown financial plan, the percentage of assets under management is a little higher just to cover that planning time. Instead of doing like a fixed flat fee, we tier it down from 1.5% to one. It goes down to 1% and even below 1%, just based on how much you have to work with to cover that planning time. But we really have a full comprehensive approach to planning, insurance, and it just kind of depends on what you're having us cover. But I'd love to chat more if you have questions on that.
Yeah. Could you explain the difference between a solo 401k and a SEP IRA?
Yeah. So solo 401k and a SEP IRA potentially allow you to contribute the exact same amount, right? The SEP IRA is all employer contribution. With a solo 401k, you're going to have the 23,500 come out of payroll, and then you're going to fund, and that has to be done by the end of the year, right? So you have to to get on payroll, you have to have money coming out of your checks, and that 23.5 has to be funded by the end of the year. And then on top of that, you can add a profit sharing feature, which allows you to fund an additional 46,500 on top of that 401k contribution. So that portion of the plan is not due until the tax deadline date. So if you're a sole prop, right, that's 415. If you're a corp or a partnership, that's 315. And that portion of the money would have to be funded by that tax filing return. The SEP IRA is all due at the tax filing deadline, and you don't put money in through payroll. You just kind of have money going in from your business account as you go through the year when you want to fund that.
Dr. Michael Leibowitz is, what are the best tax strategies for someone approaching retirement in 1 to 5 years? So this is like someone really close to fire.
That's awesome. With regard to that, I want to know, is there a business sell involved? Is there a long-term capital gain planning event? Because if there is, we need time to work for you in your favor. We want to start tax loss harvesting. And if you own a business, I want to know, can a cash balance plan, if you haven't done one, fit in your budget? You need to set those up 3 years prior to retirement, because there's a holding period of about 3 years minimum that you need to keep those cash balance plans open. So you can't just if you're going to sell your business you can't just set it up in the year of sale and then close it down. You need to have that cash balance plan running for a while, so that it has those minimum holding requirements. Other strategies, I mean, there's a lot that goes into transition planning, readjusting your investments, your allocations, and lots of planning on that front. But yeah, I think a lot depends on where you're at with your planning opportunity.
Yeah. As you get closer to retirement, you're going to be more nervous, right? So you're going to be very risk averse. So you're not going to take the risk as if you were at the beginning of your career. So I think that goes without saying. So I think we've reached the top of the hour. Thank you, Jordan, for being here, giving us your experience and your knowledge. Really appreciate working with you. Thank you, Brett from Earned. He is the Senior Wealth and Tax Advisor and a CPA who came in and give us great insights. Earned is going to be at our Prosperity Conference in March 6th through March 8th in Las Vegas. On our website, we have the link for registering. Would love to see you all and share stories about what the road to fire is. And without further ado, I wish you guys a great night, and let's thrive in 2025. It's my saying now.
I love that.
Thanks
so much for having us.
Take care.
Scan the code, and yeah, if you have things to chat, I look forward to speaking with you in a consultation.
All right. You have a good one. Thank you very much. You have a good night.